Well, good afternoon, everybody. It's Close of Business Tuesday, and we're really, really excited about today's guest. We've got two good friends from Baker Botts with us today, and we're going to go right into the structure that is so important to the energy transition, and that's the 45Q tax credit structure that's been around since 2008. It got a big redo in 2018, and they're talking about even more. But let me introduce our guest, because we couldn't be happier to have him. Barbara de Marigny is with us. She is a tax partner at Baker Botts, and Aileen Hooks is a partner in the environmental area. So, ladies, we're so glad to have you. Thank you for volunteering for a little session here on 45Q.
Well, thank you for having us. We're happy to be able to share what we know with you.
Well, we've had a lot of fun in the pregame, so we're going to have even more fun now. Let's jump in. Mike Bradley, what's happening on the screen? We've got another week of earnings. We're oilier this week than last week. Last week was natural gas, but what do you see so far?
Yeah, man, you hit it on the head. Last week was about natural gas, and all discussion last week on natural gas was the hedging and the over-hedging for a lot of people, and the hedging which tended to look pretty ugly for most producers, and a lot of those guys got damaged this week. And so this week it's really, really heavy on oily type E&Ps, specifically the large cap E&Ps. And what we figured was going to happen is that hedging was not going to be an issue. People would ask about it. The biggest issue was going to be return of capital. What forms of return of capital? How much? And one of the other things that we were thinking about too is there's probably a half a dozen companies, including some of the oil majors, that are returning capital, but there's probably going to be a half a dozen or more additional companies who are going to be near 1x net debt to EBITDA by year end this year, early next year, and they're going to start talking about their return on capital plans on their Q2 calls, and that's exactly what's played out here, and we further expect that to play out through the rest of the week. So, two areas that they're most talking about, people are on different sides of the ledger. I mean, what you see with the oil majors, they're really going more towards a fixed dividend and, share repos. And you've had a couple other guys, specifically Continental, talking about share repos, their preferred route. And while you've got some other guys like Pioneer have decided to go more of the variable dividend route. And so that's going to be a big discussion point over the next couple quarters on who's going what route. It really doesn't matter to me. What matters to me is like all the companies are dialing in sort of sub $50 oil, whereas normalized prices for most people are probably in the $60 range. So there's a nice valuation arb there. And so whatever route you decide to take, it doesn't matter. You're just giving a lot of return back to shareholders. And guess what? We're in a market now where return of capital is going to be a dog-eat-dog game because, like I said, the oil majors are now starting to get back into this game. They're going to be competing for capital in an energy market where it's 3% of the S&P. And so you're going to have to be continuing to leapfrog each other to get investors' attention. That's what we're seeing right now. So it's a great thing for the industry. Investors are reacting well. The stocks are up, and we expect to see more of this throughout the week.
And you said, just so everybody watching at home, some of whom are my relatives, when you say dialing in $50 oil, you mean embedded in the stock price is the if you unravel that $50 is the seemingly what's in there. So these stocks are cheap.
The implied long-term commodity price that's basically dialed into these equities versus what the screen shows, 2-3 years out is something in the, well in excess of $60. But we're just going to say most people think normalized is probably in the 55 to 60 range, and we're below that right now. So that's forcing some companies to say, we'd rather go the share repurchase as opposed to the variable dividend route. And when normalized price is below where the stock prices are, then we go to more of a variable dividend route. So, it really doesn't matter which way you go. What matters is that you're doing it. We're in a place where we're doing it, and guys are leapfrogging each other, and that's going to continue to be the theme through the second quarter. I think that's a great thing.
Okay, great. Thanks, Mike. So Matt Murphy's with us today. Matt's up in Calgary. He's a senior part of our research team, covers so much of the landscape of companies that we do cover, but he also does some of the macro and in particular carbon capture. But Matt, what would you tell folks what's on your mind today just watching earnings and watching the screen?
Yeah, I would actually echo a lot of what Mike's been talking about there, Maynard, in that it's been pretty important, I think, in the past week or so of earnings to continue to see the message of capital discipline from the E&Ps. And as we've been talking about for quite some time, important to hear incremental shareholder returns as featuring into the path forward on capital allocation for really the broader space. So we've seen some divergence, I think, of late in the performance of equities relative to the oil market. As we think about the path forward and closing that gap, I certainly think incremental shareholder returns is a key part of that. And so whether that's increasing the base dividend, layering in a variable dividend, or the buyback, I think important to see the total capital return yield of the space broadly. I think offering something very differentiated as investors kind of survey the broader opportunity set of the S&P. So as we think about the path forward on the macro, though, as I said, I think capital discipline, reiterating that, and some names in the space, I think pretty important as we think about the spare capacity out there as well.
So you mentioned the S&P 500. I guess, Mike, a couple of companies starting to directly reference the S&P 500 as they compare their performance and their yield, et cetera, which I think you got all excited about just looking at some of the traffic.
Yeah, I think that's really, really important, is not to compare yourself against your peers in your industry, but to compare yourself against the rest of the S&P. That's the way you're going to get generalist money attracted to your sector. And not only in basically, in spreadsheet form or, but actually doing it. And that's what's occurring right now. So that's fantastic.
All right. Well, Colin, you're up. You're our last stop on the train before we go to 45 Qville. What's on your mind?
Well, for the past 18 months, as we've talked about the path of inflation and inflation risk, we've warned that an important milestone will be when the inflationary pressures finally wind their way through financial markets and get into asset prices, particularly into housing prices and then housing rents, owner equivalent rent in particular. And that is happening right now. Just in the past week, we've gotten data that shows that demand for apartments in the United States on an annualized rate is at least a 50-year high and probably an all-time high. So we are also seeing that as there's this competition for housing, particularly in those apartments, that people are really monetizing some of their wealth or their recent wealth from equities and other investments, or they're borrowing. We've seen a massive surge in debt in the United States as well in the past 3 months. And that's just putting that pressure on that crucial component of the CPI, owner equivalent rent. Now, the fact that the data is coming in and confirming this in the month of August is also particularly worrisome in that conditions can get somewhat illiquid in global markets in the month of August. And when you look back to history, whether it's 1998, 2007, 2008, August has a little bit of a checkered history as a period of time where you don't want to have expectations ratcheted or disappointed in an adverse way. And so not a strong view, just putting it out there that we now have confirmation that the inflationary pressures are in housing. They are becoming more and more apparent in the data. The Fed will pay attention to this. And if there is a rate hike or an adjustment in the very creative monetary policy that we have, it could suddenly hit commodities and other global markets in a very short period of time.
Thanks, Colin. I think the number of times in any given week where I'm either A, shocked by the price of something, or B, see another help wanted sign in a restaurant or a diner or some, service establishment, like those are the, maybe I'm looking too closely for those things, but I just keep seeing them everywhere.
It's really impressive. And, the debate keeps on getting sidetracked on politics and kind of sidebar conversations. The whole transitory thing was one example of that. This week, my personal fear is the eviction moratorium conversation would sort of lead you in one direction. But think about it. If you have the moratorium go away and a landlord who is the villain, often in the way that the media presents this information, hasn't been paid by some of their tenants in many, many months, if there is a turnover, the new person coming in is going to be looked to as the source of recouping some of those losses, because the landlords, of course, often have mortgages of their own, utility bills, and all the rest of it. And so just keep that in mind, that when we do have the turnover here, that gives you those higher prices. Let me give you one stat that I hadn't given before. A lot of this activity in apartments is happening in Texas. El Paso now has a 97% occupancy rate. And so it's no surprise that you're feeling and seeing those pressures in Texas. The housing market is just on fire.
All right. Well, Barbara and Aileen, thank you. And, welcome to our family. That's sort of our, we're going to have to do one of these at the Thanksgiving table so we can just get everybody all dialed up about various issues. But look, you guys were so nice to reach out. I think the history on this, we, of course, have a great relationship with you guys. We had a carbon capture conference going back not too long ago, 2-3 weeks ago. And you guys volunteered and said, hey, we love 45Q. We'd love to, we talk about it a lot, and it is so important that we were just delighted to get you guys to come on and visit with us a little bit about it. Could we maybe start, Barbara, do you mind just giving a little bit of your personal history? You've got so much experience. And then, Aileen, let's do the same thing with you, just to kind of get everybody's juices flowing, because you guys have seen a ton across so much of the tax and environmental landscape.
Sure. And to echo what you said, we listened to the carbon capture conference that you had a few weeks back, and I don't think there was a single session where 45Q wasn't mentioned. So it was referenced throughout that day, but we realized that there wasn't any actual real substantive discussion around 45Q as part of that conference. And so we suggested that maybe this would be something that you'd want to have a little more discussion about. And that's how this sort of came about. Just speaking for me personally, my background is in federal tax planning and structuring, and I've been a tax lawyer for a long time. I joined Baker Botts not too long ago, 2.5 years ago, and I realized that because of the energy base of the clients of Baker Botts, that there was going to be, as we moved into energy transition and with all the revamping that was happening to 45Q, there was going to be a lot of interest in this area. And so for the last 2 years, I've really been focusing on tax issues related to the energy transition, and that means primarily 45Q. And we started a carbon capture, a CCUS carbon capture practice group at the firm. And over the course of the last year, we probably have given close to 100 different presentations to different clients and different client groups about the things that they're thinking about and we're looking at. So that's the background. And then just about every day, I talk to Aileen, and Aileen can tell you about her background, but she practices in the environmental area, and her experience and knowledge about injection wells and carbon capture is just phenomenal and has been integral to analyzing 45Q issues.
Well, see, I was going to say, Barbara, we did at the conference what we always do, which is, it's a tax thing. It's a lot of details. Anyway, getting back to the main story. So today we're unpacking those details. Yeah, Aileen, if you could tell us a little bit about your background and experience and what it really means when you say environmental, like where are you spending most of your time?
Sure, happy to. I many years ago started my career in law in the real estate world. And pretty soon into my career, evolved into an environmental lawyer who, deals primarily with issues that will affect real estate or land, surface, subsurface, and hence carbon capture is an area of tremendous interest to me. I first started working on carbon capture issues before it was popular then, but before it got to the great popularity we have now, representing a couple of stakeholders when Texas put in place its carbon capture legislation in the 2000 7 to 9 time frame, and followed it and worked with clients thinking it was going to be the next big thing around 2015 before that all fell apart. But I stayed with it and I'm really excited about its resurgence, because I actually think we are going to have, at scale commercial deployment of carbon capture in the United States, at least in my lifetime. So I think it's coming, and it's really exciting.
I don't know why, for some reason, like Ross Perot, when he was running for president, said, I can solve the deficit right away. I'll just put all these congressmen on commission, and if they make 10 cents for saving $1, we'll have the deficit done in a year. And 45Q, it seems like, hey, we're going to put everybody on commission, go capture some CO2, and we'll take it off your tax bill. But Barbara, do you want to start with maybe just a little bit of the history of 45Q, kind of exactly how it functions? It's a credit, and just give people the basics.
Sure. So one thing is, as was mentioned, 45Q was originally put in place in 2008, and it's been in the Internal Revenue Code, and 45Q is a reference to the section number, the code section number. It's been in the Internal Revenue Code since 2008, but it wasn't until 2018 that it got a big revamp that made it much more available and richer and usable. And so all of a sudden people sort of woke up and said, hey, let's see what we can do with this. This looks like this could really have legs. And so since 2018, people have really been very focused on it. So since 2018, what we have is a federal tax credit for carbon capture and sequestration that is a specific dollar amount per ton of qualified carbon oxide that is captured and then disposed of in one of 3 ways. And those 3 ways are permanent sequestration, so putting it way down deep into the earth where it's not going to come out again. The second way is disposing of it through its use in enhanced oil recovery. And then the third way is what is referred to as utilization. And that is the verb that is used, or the noun is utilization. And so by utilization, the reference is to taking the CO2 and converting it into some other product or using it in a service that, for example, chemically converts it into something else. And Maynard...
I've been planning this all week, Barbara. I had to show you this. There you go.
Is showing illustrative examples of the types of products that the CO2 might be utilized in, that in concept, in theory, could then be eligible for the 45Q tax credit.
Hey, Barbara, and you just might, because this happened to me as you were going through, you said carbon oxide. And what you told me before is at some point we said, okay, not just carbon dioxide. If you're doing carbon monoxide sequestration, you should get a credit too. So that was the
right. So and that was one of the changes that happened in 2018, was that the statute used to say carbon dioxide, and then it was asked if it could please be changed to carbon oxide so that it would encompass both dioxide and monoxide. And so if you are capturing carbon monoxide in the quantities that, we'll get into what the minimums are that are required. But if you were capturing that much carbon monoxide, you could also get the credit that way. So that's another flexibility that was introduced when they revised the statute in 2018. So carbon oxide is not a typo. It's not a typo where we dropped off the DI. It's because there is an opportunity for either. Okay, so those are your three choices of what you're going to do with it. Now, one thing to stress here, and it always kind of makes me kind of laugh, is that the statute is explicit that both the capture and the disposal, whatever it is that you're doing with it, has to happen within the borders of the United States. And so, it makes me laugh because it's as though whoever was writing the statute was thinking, well, it doesn't matter, our atmosphere is only there's a vertical wall to our atmosphere at the borders of the United States, and it doesn't matter what happens outside that. But I'm sure that wasn't the reason why they wrote it that way. But anyway, that's what we're dealing with. And so, for example, if somebody is capturing in Wyoming, but they are sequestering in Canada, they couldn't get the credit. And there is a reference to territorial waters in the regulations. And this was something where Aileen perked up on this point because the question of how you define the United States and territorial waters. I mean, there's a reference in the regulations to state waters. And Aileen, I don't know if you maybe want to speak to that.
Yeah. It's actually, I enjoy anything maritime or offshore, but what's interesting is, the territorial waters of the United States go out 12 nautical miles, which is a little bit longer than a mile. Most states within that 12 nautical miles have the first 3 nautical miles, which coincidentally is apparently the distance that in the 17th century a cannon shot could go. So that's what the state got to protect. And for some historical reason, both Texas and Florida enjoy the benefit of 9 nautical miles in terms of state jurisdiction. So when you're dealing with offshore carbon capture projects, I think generally speaking, the regulated community would prefer to deal with the state rather than with the federal government, and at least with the thought that, the permitting timelines, et cetera, will be quicker. That, Texas and Florida both enjoy an advantage because their jurisdiction goes out 3 times the distance of other locations.
Yeah, I guess just maybe you talked about some questions of receiving the credit as we consider geography, maybe crossing federal lines. But I guess as you think about the receivership of the credit, I mean, does ownership of the facilities that are capturing matter as we think about various other, I guess, members of the value chain potentially participating in the market?
Yes, absolutely. Ownership matters, and the credit is a little bit different in that the credit is attributable to, in the first instance, the credit is attributable to the owner of the carbon capture equipment. So you don't have to own the CO2. It doesn't have anything to do with title to the CO2, taking title to the CO2, continuing to own the CO2. And it also doesn't have anything to do with the size of your investment, the amount of your investment. There is such a thing as an investment tax credit where it matters how much money you put in, but that is not the case here. Instead, it's the ownership of the carbon capture equipment. So then you say, well, okay, what is the carbon capture equipment? Now, this is a very general sort of diagram just to give a feel for what might be involved in a process train for a carbon capture and sequestration project. And so all the way on the left side, you see our CO2 source, which is likely going to be a anthropogenic, man-made CO2 source. It could be a power plant, ethanol plant, hydrogen plant, anything like that, that has attached to it usually a separation unit. On here it's labeled as the CO2 capture and separation plant. But that would be your amine unit that separates the gas, the CO2 out. It could be rectisol unit, select-sol unit, different references to units like that. And then following that, you're going to have your compression unit, which would compress the CO2 to make it at a critical state so that it could be transported. Transported could occur presumably, most likely by pipeline, and going to a location where it is injected and used either for EOR or for CO2 storage. So when the statute says you have to own the carbon capture equipment, what do you have to own? And we're going to talk a little bit later about tax equity investors. Tax equity investors are very concerned that they would have to, if they have to own the carbon capture equipment, that would mean that they had to own a piece of that separation unit, because the separation unit is attached to the big facility. It's right. It's not always going to be as clearly separated out as it is in this picture. It's going to be sitting in the middle of some other big plant. And so it would be difficult to carve out the ownership of that. And luckily, happily, recently, the IRS put out a revenue ruling that clarified that their view, that they said, okay, we get it. We understand. You can't expect the party that wants the credit to have to buy and own a piece of the emitting facility. And so it's good enough if you just own a component of the carbon capture equipment, then you can get the credit. And so in the example they gave, the tax equity partner comes in and invests in the compression facility, but does not own the separation unit.
Maybe we're right here on this topic, so we maybe ought to just go ahead and hit it, Barbara. But the fundamentally, this thing it's a credit against your taxes. So if you're not paying taxes, then you can't get the credit. So there are people out there who are looking for ways to defer their taxes and get the quote credit, not just against their taxes, but for CO2 sequestration. Do you mind giving us a feel for this tax equity market that's out there and how you guys deal with them? Right.
So the tax equity, the fact that the 45Q credit is a credit against your tax liability means that it is currently pretty much worthless to you unless you have a tax liability. So if we're talking about companies that are perhaps active in the oil and gas industry and have years of net operating loss carryforwards, are not looking at a big tax liability, they can't use the credit. And so what the way that the tax law and the market has grown up around this is that you can't actually sell, you can't just do an actual sale of a tax credit. But what you can do is you can invite the tax equity investor in to partner with you, and they make their investment. They invest dollars to help you with the capital expense of the project, and then they get their return, not in the form necessarily of interest, but in sharing in the credits. And their share may be 99%. So it is not an outright sale, but it's a way to finance these projects and to use the credit as currency for that financing. And this is exactly what we have seen happen with the wind and the solar spaces that have been so heavily financed by tax equity investors. So I think the statistic is something like in 2019, there was around $18 billion in tax equity financing. Tax equity investors tend to be, they're obviously profitable companies. They tend to be the financial institutions, the big financial institutions. So of the 18 or so billion that was invested in wind and solar in 2019, if you can imagine this, about half of that was done by JP Morgan Chase and Bank of America. And then the rest was spread through something like somewhere between 30 and 40 other tax equity investors. These are rough, but just to give you a feel for what that market looks like. So now we have 45Q, and tax equity investors are starting to say, hey, we can do what we've been doing with wind and solar with 45Q. Let's talk. And by the way, the yields for the tax equity investors in wind and solar are around, maybe the way they measure their yields, they would say they're around 5, 6, 7% in that range, generally around 6%. The yields for a 45Q deal are looking, because it's a very nascent, immature market, it hasn't yet been tested, we're looking at much, much higher yields for those investors.
Barbara, that raises an interesting question. Once a credit has been granted, can it be taken away by the government?
Yes. So the term is that they don't say take away. They say recapture. That's the term that tax lawyers use. Is the credit gets recaptured, and the statute has a provision in it that allows the IRS to claw back the credit. So if you claimed the credit and it reduced your tax liability in a given year, in a subsequent year, you could lose the credit and have a tax liability equal to what you had saved in the prior year. If you have a what they call recapture event, and a recapture event, it's defined, and they have a 3-year look back right now. It's set up so that for 3 years after you claim the credit, you're exposed to having it recaptured if there is a recapture event. But here's the really interesting thing to me anyway, is the way they defined a recapture event. So a recapture event is going to be leakage. It's going to be leaking out of the well where you purported to sequester the CO2, but they measure it as the excess of the leak over the amount that you sequestered in that year. So let's say in year one, you inject 100 tons. And then in year two, you inject 100 tons. But in year two, you also have some leaking. If you leaked 5, 10, 15, 99 tons, 100 tons, you wouldn't have a recapture event. But if you leaked 101 tons in year two, you'd have a recapture of 1 ton of your credit that you'd claimed in year one. So when you can easily see that the way that's going to work is that as long as you're ramping up your injection each year, you don't need to worry about recapture. But in the year when you finally stop, when you say, okay, now I'm done, I'm not doing any more, then that next year, you're not doing any injection, you're not doing any sequestration. If you have leak of 1 ton, then you have exposure. And just to make people feel comfortable, they do have an exception for leaks that are caused by things like volcanoes and terrorism and stuff like that. So it's not just, what they're going for is a leak that's a result of a engineering problem, operational problem, not something beyond your control.
So when you, Barbara, you and Aileen are spending time on all this, and I'm sure it's been changing through the years. Clients are asking you, hey, what's going on in Washington? They're saying, does my project meet the specs? How do I get it certified? How do I document selling some of the equity? I guess there's a lot of private capital flowing in, and they're asking you for help with projects. Like, how would you characterize where are you spending the most time, and how is it changing in this environment for your clients? Like, what's driving Baker Bott's business in this area?
We are talking to people across the spectrum of groups that are interested in this across the value chain. So we're talking to oil and gas majors, but we're also talking to LNG companies. We're talking to E&P companies. So many different, and then also, quite a huge number of startups, new businesses that are organizing around being the sequesterer. And so I'm going to start a new business, and I'm going to go to all these companies that are emitting CO2 and offer to take all the CO2 off their hands and sequester it. So that there are a lot of new businesses starting up in that vein, and then private equity is investing in those businesses. So it's across the spectrum in terms of who we're talking to, and then what they're talking about. It has been, from my perspective, it's been a lot of questions about the minutia in the tax regulations, the detail, because people want to get really comfortable that they're doing things right. And then from Aileen's perspective, I'll turn it over to her. So many questions about pore space, land use, and EPA compliance. So, Aileen?
And we're on the environmental side, also going across the full spectrum of interested parties in carbon capture projects. But a lot of our time is spent on the regulatory environment, particularly permitting, whether it's going to be federal or state permitting, and what's happening in that arena, including working with clients who are actually, putting together real live permit applications to submit to, at this point, EPA and to the corresponding states, and also working on the emitter side on questions about liability, contract terms for all of the inquiries they're getting from project developers who are interested. The related part of this is dealing with companies who are, and some of them are energy companies who are going into new energy ventures businesses and putting together their frameworks on issues relating to acquiring the required pore space interests, and whether you can exercise what's called eminent domain if you have a reservoir that maybe say 40 property owners are involved, and you can only get say 25 of them to agree, and all of this is still in the process of evolution in the various states. So a lot of activity working in an environment that is being formed.
Barbara, I think we've seen a lot of coverage of late on potential infrastructure proposals, low carbon legislation, what have you. I guess we kind of think through the path forward for CCS and the 45Q. I mean, can you talk a little bit about what we should be keeping our eyes on as this space progresses?
Absolutely, yes. There have been in the last year any number of bills that were suggesting improvements and enhancements to 45Q. And we expect that those proposals are going to appear in some form in the reconciliation bill, which hasn't yet come down the pike. So this week we got the text of the infrastructure bill, and there's very little in that infrastructure bill that speaks to 45Q. There's a bunch of stuff in the infrastructure bill about carbon capture funding, sort of DOE funding, grants, et cetera, for carbon capture, but nothing specifically about or very little about the specifics of the tax provision. So that's not in this week's restructure bill. reconciliation bill is expected to deal with all the proposals that have come up about 45Q. And there are 2 points that are probably the most significant that could work a sea change. One is that the Wyden Clean Energy for America bill had in it a proposal that sort of startled people, which was that the credit could be taken away for EOR. In other words, it would only be permanent sequestration or utilization that would get the credit, and EOR would not get it. Our sources that stay very close to these things on the Hill tell us that it's their understanding and feeling that that is not going to be part of the reconciliation bill, that it won't be in there, which is a relief because so much of the focus under 45Q has been on the use of carbon in EOR. The other change, I mean, there's a list of smaller or less important changes that relate to things like reducing the minimums that a qualified facility has to meet and raising the dollar per ton amount, et cetera. But the other one that everybody is talking about that I would encourage everyone to keep your eye on is the proposal to convert the credit into what's called a direct pay credit. And a direct pay basically means instead of it being a credit against your tax liability, you could say, just give me the cash, okay? And if that happens, then you would not, there is likely to be there's going to be a change in the role that tax equity plays in this space, because in that instance, someone who does not have a tax liability cannot use the credit because they don't have a tax liability, can say, I sequestered this much CO2, that's equal to X dollars. I want those dollars in the form of a refund. And so any company, any oil and gas company, even if it's got a big NOL and has no tax liability, could access the cash. And in that case, the tax equity investors there will still be a role for tax equity because, somebody has to come up with the cash to make the capital expenditures to build the carbon capture equipment. So if the tax equity investors have that cash, they end up functioning almost like a bridge loan type financing, even in the direct pay. It could be even in the direct pay context. But that direct pay proposal is one that, if it passes, and it's been proposed across the board, bipartisan proposals, if that gets passed, then that will definitely affect the environment for these investments, I think.
One thing I'll mention that's not directly related to 45Q, but the provisions that got added to the infrastructure bill, which are intended to really, help with the scaling of carbon capture, include a provision that would be a funding source towards a common carrier pipeline for CO2 that would have a tariff schedule, and would be common carrier, which is not how, at least most of the folks I've been talking to in the pipeline sector have been envisioning what their model would look like. So it'll be interesting to see what develops with the common carrier approach to carbon dioxide pipelines.
Is this market starting to see people that, the tax credit's great, but what I'm really interested in is I want the quote credit for sequestering some CO2. So I'm using it to balance out my company's footprint. So let's put some money in this pipeline and I'll take my percent of the CO2 that got sequestered and I'll use that to, an offset type market. Is that growing here?
Yeah, absolutely. I'll say absolutely. I mean, I have clients who have, companies, a 2050 net neutrality goal on carbon that are looking under every rock they can find in terms of how they would have credits to meet that goal. And certainly The geologic sequestration of carbon capture is one of those. And as this all develops, it needs to be put together in a way where you don't have double counting, and you have the integrity of the programs for people who are trying to meet their social carbon goals.
Yes, and we might just mention too that the 45Q credit is a federal tax credit, but there's nothing that prevents you from getting the 45Q tax credit and at the same time getting certain regulatory credits, like, very importantly, the California LCFS, Low Carbon Fuel Standards System, offers a credit that right now we understand is trading around close to $200 a ton. Mm-hmm. And so you could stack, your $50 a ton with the federal credit, with the $200 a ton for California, and the thing gets really rich that way. So.
Would I have to get that by sequestering in California, or do I just get it because I'm selling the fuel in California that is associated with a sequestering process, or how does that work?
You don't sequester in California, and you don't need to. And I think it would be probably, harder to get permits there than in many other states to do that. The project can be elsewhere. My understanding is there are maybe 2 projects that are both associated with EOR that are in the evaluation stage to qualify for LCFS credits in California.
Well, see, Aileen and Barbara, we had Bill Maher at our conference early this summer, and he was complaining about solar installation times in California. So carbon sequestration times might be even longer. Well, guys, we can't thank you enough for coming on and taking something that is a little bit confusing. That's probably why we didn't have a panel on it. And, unpacking it for us. Let me throw it to Matthew, Matt, and Colin. Anything else before we sign off today?
Yeah, and maybe just one, as we talk about some of the changing dynamics on the topic, legislation or otherwise. I guess utilization, it seems like one of the more interesting areas, or at least some of the more non-traditional forms, if you will, other than EOR. I guess just as we think about it, again, sort of the various parties potentially participating in this market, the credit, I guess, can you talk about how those utilizers might participate and some of the nuances perhaps around that?
Right. Well, the utilization area is fascinating because there are so many new products coming out and uses for CO2 in the way that carbon can be used in different products. We joke about the Dr. Pepper and the Slim Jims, but in theory, those products are eligible for the credit. As far as we know, no one has yet claimed the 45Q credit for these products, this chemical conversion into a product, and this is the reason why. The credit is based on the number of tons that you sequester or dispose of, and so this. In the case of sequestration and EOR, we have a very clear measurement or we can measure that. But the statute for utilization says that they are going to have the taxpayers perform what's called a life cycle analysis, an LCA. And that life cycle analysis is to determine the amount of carbon reduction that's associated with that product by virtue of using the captured CO2 instead of making the product some other way. And so this calls for a need to have a third party, like it's typically going to be an environmental consultant, environmental consulting firm that performs this analysis where they soup to nuts, kind of, cradle to grave, look at this product and say, how much CO2 are we emitting and how much are we saving by making the product this way? And then the IRS has now said that you have to submit your LCA for approval to the IRS and the Department of Energy. And you're not allowed to claim the credit until they have approved your LCA. And from what we heard very recently, like in the last month, nobody has yet come into the IRS with an LCA for them to, to have a guinea pig to reach a conclusion on. So we don't think anyone has claimed a 45Q credit yet for utilization. And yet at the same time, it opens up. I mean, it's just a huge new possibility and a way to get the credit. And there are lots of products and services that should be eligible for it. So.
Well, Barbara and Aileen, I think I got it now. We're going to start making presentations out of compressed CO2. So every time people will be so glad to see us. No, seriously. I also felt like there was a North Face joke in there somewhere, but I don't know if. But anyway, again, thank you guys so much. And everybody who's watching at home, please reach out to Barbara and Aileen, and we'll attach to some of the slides that you provided us. And you guys are doing great work. We'll need to have you back in, not too long to hear how this whole thing is changing, because it's going to change a lot.
I really do. I'm really looking forward to a year from now. Seeing how the landscape has evolved as people get used to working with credit and complying with all the rules. It's an exciting time.
Fantastic. Well, thank you again, and thanks everybody. Thanks, Matt. Thanks, Colin.